it has been a remarkable mathematical bounce off of the lows. We're about 25% off the lows on a closing basis, almost 30% off the intraday lows in the S&P 500 in the U.S. So optimism has quickly come surging back in. But at the end of the day, we do have an expectation and a degree of optimism that the ultimate landing zone for tariffs is at a reasonable, palatably enough place that global trade and global economies and therefore markets can continue to make their way through this turbulent start to 2025.
Europe has also seen a huge benefit. I mean, the whole of coverage really for the first 6 months of the year that we were doing in the last couple of days has been about the strength of the euro and the strength of European stocks. Again, for the second half of the year, is that something that persists in your mind?
It's a bit of a heartwarming coming home story, so to speak, which has good, valid reasons behind it in our belief. You've got the German infrastructure package, a greater degree of optimism about what security-oriented spending can do to contribute to the flywheel of economic growth, a greater willingness to invest here in the region, and a reconsideration of how long the U.S. dollar and how concentrated in U.S. assets a lot of global investors want to be. It doesn't necessarily mean that global investors need to flee the U.S. or anything like that. But if a lot of market participants decide that they might want to invest a bit more internationally once again, then Europe stands to benefit from that flow of funds.
Is this what this is about? It's about a balancing rather than a full retreat from the U.S.
I like the way you put that. I would agree. I think you're right. A balancing, a little bit of a rebalancing, as opposed to a drastic shift from one particular geography to another. And that's probably sensible because the reality is the U.S. has done so well from an economic growth, labor productivity, market performance standpoint, really for about a decade and a half since the GFC, the global financial crisis. Therefore, U.S. overweights have gradually built up in a lot of portfolios. So if there's a bit of a revisiting to being more globally oriented, then again, that rebalancing alone could help benefit this region and other attractive international markets in our viewpoint, which include India and Japan.
Should investors be more concerned about the US's twin deficit, about the Trump tax and spending bill that is going through the House and may well get passed in lightning speed, perhaps by July 4th? You know, budgets in the US notoriously difficult to get passed into legislation, and this is trillions of dollars worth.
It is. Most expectations calling for an increase of the totality of U.S. long-term debt over the course of a number of years by in the range of $3 trillion off of an already incredibly high base. There might be a little bit of back and forth between the Senate and the House in the coming days, but whatever final form the bill might take, where it does look like there is a good amount of momentum to getting something done rather soon, it's an upside boost to some of those debt stories and those debt numbers. One might think that that would cause a degree of consternation in the bond market and bond yields to be drifting higher, but that is not, in fact, what we've been seeing. It was mentioned earlier where the U.S. 10-year yield is. It's at reasonable levels. We were closer to 4.6 amidst all of the tariff uncertainty a short while ago. And it seems as though what the market will bear is proving to be okay. So what I mean by that is the reality is the bid to cover ratio on U.S. Treasury auctions remains okay, and therefore yields also remain okay.
Yeah, all the concern about the bond vigilante seems to have been put back in the box, at least for now. We saw in yesterday's session we saw a bit of a rotation out of some of the big tech names, or at least out of the Nasdaq 100, seemingly into Russell 2000 small caps. Some are reading into that was a sign of investors positioning around the fiscal stimulus that could come through domestically as a result of this tax and spend bill. Is that likely to be a sustained theme? Do small caps get a lift in this environment? Have they been overlooked?
Could be to a degree. We still see greater earnings growth potential in tech driven by the incredible increase of the rate of adoption of AI and the very cyclically sensitive and cyclically boosted financial sector, particularly when the cycle is doing well. There's also quite a lot of talk about a bit of a lightening of some of the regulatory requirements upon the big banks in the U.S., which have proven to be quite stable and secure, and therefore regulators and the Fed seem to be saying, you know what, maybe we can lighten some of the reins on these institutions because they're navigating their way okay, and that would also result in a greater amount of liquidity being released into the system. It could help further M&A, IPO, greater deal activity, money in motion, and so forth.
I hear a lot about diversified portfolios. What does a diversified portfolio mean to you now?
I suppose part of the way I would describe it is that it means not being overly concentrated in any one particular thing, any one particular geography, and expanding beyond the realms of the traditional, just so-called 60-40 portfolio. So to us, the idea of a diversified portfolio means being globally oriented and also having a healthy dose of alternatives into the portfolio if an investor can bear the liquidity profile of that. We think that the hedge fund space is very attractive. Its ability to go long and short, be nimble, play some of these relative value and macro stories. We've got FX volatility that's come surging back. Interest rates are on the move. There's a lot of things that suggest that the hedge fund space can capitalize on some of these movements, and then other longer term oriented alternative strategies such as private infrastructure we think can provide good ballast to the so-called traditional 60-40.